Here in Germany, obviously, we've seen the same effect on the interest rate side as we've seen in other places in the world, but the banking system has absorbed them well. Just a handful of small banks may have elevated risks that we're looking at more closely, but there's absolutely nothing systemic there coming out of the interest rate shock. The banks had reserves or capital buffers in place that allowed them to absorb that. So yes, the system's taken some pain, but no, there's no systemic danger out of that risk in our market at this point in time.
Yeah, the banking crisis, if you may call it like this, in the United States doesn't seem to be over. So what is your prediction here, and will there be spillover effects also to the continent?
Well, I think sometimes we use the word crisis too often. I think we don't have a global banking crisis at the moment, but we have a nervous time and a kind of real-life stress test for parts of the system. And we know that stress phases in finance and in the markets tend to, they come in stages and come in waves. And we don't know that the rate hikes part of the cycle is past, and we haven't seen all the effects of the interest rate rise that we've already had in the markets and in valuations. So I would say, we're paying in a way the price for the low interest rate policy of the past. We haven't yet seen all of that crystallize.
Some fund managers do say that the next potential crisis or stress could come from the commercial real estate sector in the United States, but probably also here, because we're having the same system in a way. So are you concerned about the developments on the real estate side?
Yeah, when we look at real estate, then I think where we have most focus is on the commercial real estate side, and not just in Germany, but also internationally, because German banks and German investors are engaged in markets outside the borders, and we know the pressure that this market is under, obviously because rates are now not what they were when a lot of property was financed, and a lot will come up for refinancing, but the structural change in parts of the market when we think about office and retail that weren't foreseeable at the time of that financing. So there is stress to come in that market, and it is one of the areas that we have in focus. It's not the largest risk category for our banks, but it's one of the ones that could cause some credit risk issues. So we've got that in focus. We think the risk management is adequate from what we can see, but there are going to be some credit losses when things get difficult in real estate markets or economies.
Do you think the banks have taken enough provisions for those potential losses ahead?
I think that's something we do have to look at. I think the provisioning has been low and declining over recent years. Yes. Also, when you look at potential credit losses in the corporate sector, so that buffer that you have out of provisions is not particularly material. So it's very important that there are other buffers in place. The capital buffers, we have macro-prudential buffers in place here in Germany, which we activated on all credit and a top up on real estate credit to make sure that there's extra resilience in the system. We put that in place before this turbulence, and just to have an extra degree of security there in the system on the capital side.
Let me bring you back to the stress back in March, because it was clearly also driven by social media. It was much faster than a previous crisis. So how concerned are you about the interplay of social media, financial system, and that could actually lead very fast to liquidity crises?
Yeah, liquidity stress comes faster than it used to. I think that's not something we've just seen in the last couple of months. I've been observing that over years, and it's not just a social media phenomenon. Media cycles are faster, much faster than they were. We live in this kind of 24/7 information society, and not all of that information is easily digestible. Not all of that information may be true, but it's triggering behavior, and the digitalization of banking means that there's less friction when you want to move your money around, and undoubtedly things move faster than in the past and faster than we've regulated for. So there we see a gap in or an issue with the regulation in how you deal with the speed that people move their money, in particular uninsured deposits.
Are you planning to change the regulation to tackle that problem?
That's a global issue.
Yes.
We've seen the same issue pop up in the United States and in Switzerland, just to name two jurisdictions. There are global standards for liquidity regulation set by the Basel Committee. That's the place to go to look at how to revisit that regulation.
Let me ask you about shadow banking, because clearly, I mean, there's one big event always happening in Berlin, the super return, where the private equity industry is meeting. And it's quite interesting that on their main day, they just talk about private credit. They will talk about private credit. So it gives you an idea of how important that is. So what do you think about this shift towards that, like you don't call it shadow banking anymore, but towards that sector?
Well, there's been a big shift.
Yes.
So the materiality of the sector is much higher, but it's much less concentrated than when that risk was in the banking system, which is fundamentally a good thing. Thing is that it's less transparent, so we see the interconnectivity less. And there's a lot of leverage being deployed in that sector. And so that combination of lack of transparency, high leverage, and market valuations, which have been vulnerable or still look vulnerable, that gives me still some cause for concern. And although we haven't seen much in the way of issues coming out of the asset management or the hedge fund space, we did have a fund-driven meltdown in the UK pension fund sector, which drove the gilt market into such a spin that the central bank stepped in as market maker of last resort, which is something they shouldn't be doing. So it is real that when leverage is built up intransparently and too much of it in that sector, there comes a spillover.
Let's look at the BaFin itself, because you, of course, are restructuring, changing how BaFin is run. So how much of the job is done?
Yeah, you're never done. You're never done. And we're a big team of several thousand people. And we are, I think, acting more transparently, more actively. We're much more visible. I think, our supervision has become more effective. So we're well underway on the way to being, again, a supervisor of world repute. But the job is absolutely never done, and you shouldn't think like that, right? You shouldn't think there's a level that we'll reach and then we can lean back.